in relation to incomes, home prices have never been higher. We have never seen an equity bubble that is this high, where it's in relation to the economy, not just the price of equities, but in relation to the economy. Never been higher. We've never seen credit spreads this narrow before. There's massive distortions all existing together. So you could make a cogent argument, well, this is going to be a very big wipeout in the stock market.
You're watching Silver News Daily. Subscribe for more. Michael Pento, the founder of Pento Portfolio Strategies, is a renowned financial expert and active money manager known for his in-depth market analyses and forward-thinking investment strategies. In a recent interview, Pento made a bold prediction that silver prices could potentially soar to $1,000 per ounce. This significant forecast has garnered attention in the financial world, especially among investors and analysts seeking to understand the underlying factors driving this potential surge in silver prices. Pento's insights are rooted in a comprehensive analysis of economic indicators, market trends, and global economic factors, making his predictions a topic of great interest and importance.
Are in a good place. They're in a good place. $35 trillion in debt, 125% debt to GDP, $1 trillion in interest payments, $1.7 trillion deficits. The debt to GDP was about 60% a few decades ago. Now it's 125%, 123, 125%, around that level. And that's a good place. Dunnigan, if the debt and deficits are in a good place now, when we have prosperity and their ratio, I'm not just talking about the outstanding debt, I'm talking about the ratio is growing. So, the debt is growing faster than GDP. That's unsustainable, and she thinks we're in a good place. In good times, well, Janet, we're not in a good place. We're insolvent in good times. But when a recession comes, and I think it's coming, the data is telling me it's coming, and then unemployment rates spike, and then the automatic economic stabilizers kick in, and we have a $6 trillion deficit. I mean, who's going to buy it? Are we going to be a good place? Are we going to be in a really good place? Really, really good place then? So our leaders have gone insane, and all people care about is how good NVIDIA did today. But I mean, I don't do that. I try. My charter is to make money in good markets, bull markets, bubbles, and also to get the heck out of harm's way when I see a bear market coming that's derived from a liquidity crisis or a recession. And we are headed there. I'm not positioned for it yet, but I'm prepared to get there quickly.
As of the most recent data, silver XAG/USD is trading at approximately $30.99 per troy ounce, reflecting a notable increase from previous levels. This upward trend is part of a broader movement that has seen silver prices climb by over 30% since the beginning of the year. The recent price rally has been fueled by a complex interplay of factors, including investor anticipation of Federal Reserve Chair Jerome Powell's congressional testimony, which is expected to provide critical insights into the Fed's monetary policy outlook. The market sentiment around silver has been predominantly bullish, driven by expectations of a dovish stance from the Federal Reserve, with the CME Group's FedWatch tool indicating a 77% probability of a rate cut in September. Up from 66% just a week ago, the appeal of silver as a non-yielding asset has strengthened. Lower interest rates generally make non-yielding assets like silver more attractive to investors, as the opportunity cost of holding them decreases. Silver's dual role as both a precious metal and an industrial commodity adds to its unique price dynamics. Unlike gold, which is primarily a store of value, silver's price is heavily influenced by its industrial applications. This dual nature means that silver prices are sensitive to economic growth prospects, as well as monetary policy decisions. For instance, advancements in sectors such as renewable energy and electronics have increased industrial demand for silver, contributing to its recent price gains. Technical analysis also supports the current bullish trend in silver prices. The daily chart for XAG/USD shows a recovery from recent losses, with the potential for a breakout if prices move through last week's high at $31.49. Such a breakout could set the stage for a rally towards the 11-year high of $32.52. Conversely, a move below the key support level at $30.59 could trigger a decline towards the 50-day moving average at $29.75. and 67 cents. This nuanced technical landscape underscores the importance of monitoring price levels and market sentiment closely. Furthermore, the broader economic environment plays a crucial role in shaping silver prices. For example, the recent jobs report indicating a rise in U.S. unemployment to 4.1% has shifted market expectations, further supporting silver prices. Economic data releases such as the Consumer Price Index, CPI, are pivotal for silver traders as they provide insights into inflation trends and potential monetary policy adjustments. Cooling inflation could reinforce expectations of rate cuts, while persistent inflation might prompt a more hawkish Fed stance. Overall, the short-term outlook for silver remains cautiously optimistic. Market participants are closely watching Powell's testimony and upcoming economic data releases, which could trigger significant price movements. A dovish Fed stance coupled with signs of economic resilience could create a bullish scenario for silver, potentially driving prices higher. However, unexpected hawkish signals or weak economic data could quickly alter market sentiment and impact silver prices. In summary, the current trends in silver prices reflect a confluence of factors, including monetary policy expectations, economic indicators, and industrial demand. Michael Pento's analysis suggests that these trends, combined with broader market dynamics, could pave the way for silver to reach new highs, potentially even approaching the $1,000 mark in the long term. Investors and analysts alike should remain vigilant, keeping a close eye on market developments and economic signals to navigate the evolving landscape of silver prices.
Commercial real estate, auto loan defaults are spiking, credit card loan defaults are spiking, even higher than they were prior to COVID. Rate of change is really moving higher. So and you ever ask yourself this question, well, why is Jerome Powell and the maniac people who run DC, Elizabeth Warren, people who run Wall Street, like, Barry Sternlicht, who run real estate investment trusts, why are they crying? Oh, we need more rate cuts. Oh, please, you don't get it, Mr. Powell. Please cut the interest rates. I mean, inflation has risen to a point where if you look at some of these sentiment surveys, University of Michigan, I'll point out, the U.S. consumer is on its back. They've been wiped out. The lower three quintiles have been wiped out because of the inflation that's already happened. So maybe this might be news to our president, Joe Biden. But inflation isn't coming down the way he thinks about it. Prices aren't falling. The rate of change is falling. So inflation went from 9% to 3.3%. That's still higher than 2%, right, Dunnigan? But when inflation is rising at 3.3% from a level that's already wiped out the purchasing power of the middle class, how does that help them? And Powell wants to declare victory now and start cutting rates, not because he cares about Main Street, not because he knows when he cuts interest rates, home prices will go even higher and be even more unaffordable, and oil prices and commodity prices will boom, and we'll have more inflation. I mean, that's the risk he's taking when he's cutting interest rates, especially if he does it aggressively. But he's doing it to protect banks, because that's all he really cares about. And Janet Yellen, Treasury Secretary Yellen, says, according to her, she thinks that the deficit and debt are...
The Federal Reserve's monetary policy is one of the most significant factors influencing silver prices, and Michael Pento's analysis emphasizes its critical role. The anticipation surrounding Federal Reserve Chair Jerome Powell's congressional testimony highlights the importance of the Fed's policy outlook on the precious metals market. Investors closely watch for any hints of a dovish or hawkish stance, as these can have substantial implications for silver prices. A dovish stance from the Fed, characterized by lower interest rates and increased monetary stimulus, tends to be bullish for silver. This is because silver, like gold, does not yield interest or dividends. When interest rates are low, the opportunity cost of holding non-yielding assets decreases, making silver more attractive to investors. Additionally, monetary stimulus often leads to higher inflation expectations, which can boost the appeal of silver as a hedge against inflation. Recent signals from the Federal Reserve have been closely monitored by the market. The CME Group's FedWatch tool, for instance, indicates a 77% probability of a rate cut in September, up from 66% a week ago. This increase in the probability of a rate cut reflects shifting market expectations based on economic data and Fed communications. If Powell's testimony confirms a dovish outlook, it could further support the bullish case for silver. Powell's appearances before the Senate and the House are particularly crucial because they provide direct insights into the Fed's thinking. Any indications of a willingness to cut rates or implement other accommodative measures would likely propel silver prices higher. For example, during his recent testimonies, Powell acknowledged the challenges posed by rising unemployment and slower economic growth, which could justify a more accommodative monetary policy stance. Moreover, the evolving labor market scenario, with U.S. unemployment rising to 4.1%, has already shifted market expectations towards a more accommodative policy. Lower interest rates generally support the prices of non-yielding assets like silver. This is because when borrowing costs are lower, investors seek out alternative stores of value, such as precious metals, to preserve their wealth. Inflation data also plays a pivotal role in shaping Fed policy, and consequently, silver prices. For instance, Thursday's Consumer Price Index, CPI, report will be closely watched. Cooling inflation could reinforce expectations of rate cuts, while persistent inflation might prompt a more hawkish Fed stance. Given silver's sensitivity to inflation trends, the CPI report can significantly impact its price. Additionally, the Fed's policy decisions are influenced by global economic conditions. Trade relations, manufacturing activity, and advancements in sectors like renewable energy and electronics also affect silver prices. As the Fed navigates these complex dynamics, its policy choices will continue to have profound implications for the silver market. Michael Pento's analysis suggests that the Fed's monetary policy is at a crucial juncture. A dovish stance, characterized by rate cuts and potentially more quantitative easing, could drive silver prices higher. Conversely, if the Fed adopts a more hawkish stance to combat persistent inflation, it could temper silver's upward momentum. Investors should remain attuned to Fed communications and economic indicators to gauge the likely trajectory of monetary policy and its impact on silver prices. In summary, the Federal Reserve's monetary policy is a key determinant of silver prices. Michael Pento's insights underscore the importance of understanding the Fed's stance and its implications for the precious metals market. As investors await Powell's testimony and other economic data releases, the outlook for silver remains closely tied to the Fed's policy direction. This makes it imperative for market participants to stay informed about the Fed's actions and their potential impact on silver prices.
We have to look at everything in relation to something else, GDP or incomes. Well, in relation to incomes, home prices have never been higher. We have never seen an equity bubble that is this high, where it's in relation to the economy, not just the price of equities, but in relation to the economy. Never been higher. We've never seen credit spreads this narrow before. We've never seen this amount of credit card debt, corporate debt, CLOs, private credit. So there's massive distortions all existing together. So you could make a cogent argument, well, this is going to be a very big wipeout in the stock market and in the asset prices. And by the way, that would be healthy that's what recessions are supposed to do. They're supposed to reset. It's a cathartic cleansing, purging of all the excesses. So I actually hope that happens. It would be the best thing for this country. The question is, what does Jerome Powell and Janet Yellen do about it? I'm afraid they might go back to ZIRP, and they might go back to QE. They might go back to helicopter money. But if they do so, this is the first time they're going to be doing it when the nation is starting off as an insolvent state. We've never had debt to GDP this high. We've never had trillion-dollar deficits before. And they'll be doing that QE and ZIRP, doing that action to reliquify the money markets when inflation is way above their target and has already wiped out the middle class. So, I mean, am I sure? Are you sure that when the Fed announces we've gone back to ZIRP and we've launched a QE and helicopter money is coming from the Treasury, are you sure long-term rates go down? I don't think so. I'm not sure. Long duration bonds could actually go up in yield, down in price. And if that's the case, then what you're doing isn't going to save the housing market, right? It's not going to save much of anything. It's going to exacerbate the condition. So in other words, I'm trying to say there's not an easy out this time. like there was every other time since.
Economic indicators are crucial in determining silver prices, and Michael Pento's analysis highlights their significant impact. These indicators offer insights into the economy's health, guiding monetary policy decisions that affect the precious metals market. Labor market data, inflation metrics, and consumer price index, CPI, reports are particularly influential. Recent labor market data has shown a rise in U.S. unemployment to 4.1%, which has shifted market expectations towards a more accommodative monetary policy. Higher unemployment signals economic weakness, prompting central banks like the Federal Reserve to consider lowering interest rates to stimulate activity. Lower interest rates make non-yielding assets like silver more attractive, as the opportunity cost of holding them decreases. The increase in jobless claims and the highest 4-week moving average since September 2023 suggest a slowing economy, supporting the case for potential rate cuts by the Federal Reserve, thereby boosting silver's appeal as a store of value. Inflation data also plays a critical role. The Consumer Price Index, CPI, is a key measure of inflation that traders watch closely. Silver is often seen as a hedge against inflation, rising when inflationary pressures increase. Therefore, CPI reports significantly impact silver prices. If the CPI report indicates cooling inflation, it could reinforce expectations of rate cuts by the Federal Reserve. Conversely, persistent high inflation might prompt the Fed to adopt a more hawkish stance, potentially tempering silver's price rise. Michael Pento notes that persistent inflation might compel the Fed to maintain higher interest rates, reducing silver's appeal as an inflation hedge. Consumer spending and retail sales data provide insights into economic health and consumer confidence. Strong consumer spending indicates economic resilience, supporting industrial demand for silver. Weak retail sales signal economic slowdown, potentially prompting the Fed to adopt a more accommodative monetary policy. Recent disappointments in retail sales and other economic indicators suggest a weakening economy, which supports the case for lower interest rates, driving silver prices higher. Manufacturing activity and global trade relations also influence silver prices. Silver's industrial applications make it sensitive to changes in manufacturing output and trade dynamics. Advancements in sectors like renewable energy and electronics drive industrial demand for silver, boosting prices. Global trade relations, particularly between major economies, can impact silver prices as well. Trade tensions or disruptions affect industrial production and demand for silver, influencing its price. Technical indicators such as support and resistance levels play a role in determining silver prices. A move above key resistance levels could trigger bullish momentum, attracting more investors to silver. Conversely, a drop below critical support levels could lead to selling pressure. Technical analysis of silver's daily chart shows potential breakout points, with prices targeting last week's high at $31.49. A successful breakout could pave the way for a rally towards the 11-year high of $32.52, while a move below the support level at $30.59 could trigger a decline towards the 50-day moving average at $29.67. Broader economic conditions, including GDP growth, fiscal policies, and geopolitical events, also impact silver prices. Economic growth prospects influence industrial demand for silver, while fiscal policies and geopolitical developments affect market sentiment and investor behavior. Michael Pento's analysis suggests that the current economic environment, characterized by mixed signals and potential headwinds, supports a cautious but optimistic outlook for silver. The interplay of these economic indicators and Federal Reserve policy decisions will continue to shape the trajectory of silver prices. In conclusion, economic indicators such as labor market data, inflation metrics, consumer spending, manufacturing activity, and broader economic conditions play a crucial role in influencing silver prices. Michael Pento's analysis underscores the importance of closely monitoring these indicators to understand their impact on the precious metals market. By keeping a close eye on these factors, investors can better navigate the complexities of the silver market and make informed decisions.
Made me think of something. I was shopping at Publix down here in Florida yesterday, and I needed a underarm deodorant, and we both looked at each other. An Old Spice deodorant, aluminum free, was like $9, and we both, my wife and I, looked at each other. When did that happen? $9 for a deodorant, a stick of deodorant. My plan is to do this. I'm going to follow the model that I built over decades. It's called the inflation deflation economic cycle model. and it allows me to protect and profit from recessions, bear markets, liquidity crises, depressions, which I think we could have a truncated sojourn um, in the near future. That's the salient risk there, because we have. Why do I say that? Because I'm a Cassandra who likes to use hyperbole. That could be. I mean, some people might think that. Or do I see concurrent bubbles that we've never had exist. Concurrent means existing at the same time. We've never had them. We've never had a bubble in real estate, and a bubble in the equity market, and a bubble in credit like we've had, all at the same time. You think about the year 2000. It was not even really an equity bubble. It was mostly a Nasdaq bubble. And then in the aughts, 2006, 2007, we had a real estate bubble. It wasn't really an equity bubble. But now you have a bond, stock, and real estate bubble, all existing concurrently, and they're at record proportions. I mean, we've never had a home price to income ratio this high, never. Now, I understand that the home ownership construct is better than, we don't have the liar loans, we don't have 110% loan to value ratios. That's a lot better. But what we do have this time is we have 25% of all homes, single family homes, owned by investors. Even though they own the home outright or they have a very little mortgage on it, it's still a home that they don't need to live in. It's rented out. So if you have a recession and you have the unemployment rate tick up and the stock market starts to fall, they will be looking for liquidity from these homes that are falling in value, that are no longer rented because your renter stopped paying you, and you need liquidity. So the inventory, the shadow inventory, can come on the market almost to the extent that it did in the subprime crisis. And then you have the home prices that have never been higher, not just nominally speaking. I always like to look at the ratios because, look.
One of the key aspects that sets silver apart from other precious metals like gold is its significant industrial demand. Michael Pento's analysis highlights how silver's unique position as both a precious metal and a crucial industrial commodity influences its price dynamics. Industrial applications account for a substantial portion of silver demand, adding complexity to its market behavior. Silver is widely used in various industrial sectors due to its excellent electrical conductivity, thermal conductivity, and reflective properties. These characteristics make it an indispensable component in numerous technological and industrial applications. The growing demand from sectors such as renewable energy, electronics, and automotive industries plays a crucial role in driving silver prices. In the renewable energy sector, silver is a key material used in photovoltaic cells for solar panels. The push towards green energy and the increasing adoption of solar power have significantly boosted the demand for silver. As countries worldwide strive to meet renewable energy targets and reduce carbon emissions, the production of solar panels is expected to rise, thereby increasing the demand for silver. This trend is particularly strong in regions with substantial investments in renewable energy infrastructure, such as China, the United States, and the European Union. The electronics industry is another major consumer of silver. It is used in the production of various electronic components, including semiconductors, switches, and connectors. The ongoing advancements in technology, coupled with the proliferation of consumer electronics, have sustained robust demand for silver. The rise of technologies like 5G, the Internet of Things, IoT, and artificial intelligence, AI, further amplifies this demand. As these technologies become more integrated into everyday life, the need for silver in electronic devices will likely continue to grow. Additionally, the automotive industry is increasingly turning to silver for its applications in electric vehicles, EVs, and hybrid vehicles. Silver is used in the electrical contacts and circuits within these vehicles. With the global shift towards sustainable transportation, the production of EVs is expected to increase substantially, thereby boosting silver demand. Governments and automotive manufacturers worldwide are investing heavily in EV technology, driven by environmental regulations and consumer demand for greener alternatives. Michael Pento emphasizes that these industrial uses of silver create a dual demand dynamic that is sensitive to both economic growth and technological advancements. When the economy is robust, industrial production typically increases, leading to higher demand for silver. Conversely, during economic downturns, industrial activity may slow down, potentially reducing silver demand. This dual nature makes silver prices more volatile compared to gold, which is primarily driven by its role as a safe haven asset. Moreover, the ongoing innovation in various industries continues to find new uses for silver, further driving its demand. For instance, the development of silver-based antimicrobial coatings and medical devices has opened new avenues for silver consumption. These applications have gained prominence, especially in the wake of the COVID-19 pandemic, as the demand for hygienic and antimicrobial.
I think we're going to have a lot of problems in the repo market, in the money markets, in the stock market, and in the bond market. Those are the things I'm looking at, Donegan. It's not time to panic yet. I'm just saying, if you're going hog wild over your skis in NVIDIA and going golfing and enjoying your life and saying, you know what, all you need to own is the number one stock in the AI phenomenon, you're in for a rude awakening. Because in my 33 years of doing this, being a licensed professional, this type of scenario has never ended well. And I look at something like the market cap of equities, total market cap of equities to GDP. It's 190 something percent right now. That's the highest reading ever, outside of like a couple of weeks immediately after COVID. So for reference, that ratio was 104% in 2007. It's almost 2 times more expensive. And in 2007, the market crashed by 50%, the S&P 500. Even though the bubble wasn't extent in equities, it was in real estate. And if you look at things like, well, how narrow the rally really is in the stock market. Because if you ask most people, they say we're in a recession and we're in a bear market. Because most stocks are down on the year. But if you look at NVIDIA is now worth over 10% of our entire US GDP. And if you add in Microsoft, NVIDIA, and Apple together, over 33% of US GDP, the total annual production and output of the United States, is less than those 3 companies. That's insane. The total market cap of equities to GDP should only be about 50-60%. But now we have 3 companies representing over a third. So this is a very narrow rally. We're heading into a recession. Banking system is under a lot of stress. Net interest margin.
Global economic factors play a significant role in shaping the demand and price dynamics of silver. Michael Pento's analysis highlights the complex interplay of international trade relations, manufacturing activity, and technological advancements that influence the silver market. These broader economic considerations add another layer of complexity to silver's price movements and are essential for understanding its future potential. Trade relations between major economies have a direct impact on the demand for silver, particularly its industrial applications. For instance, tensions or disruptions in trade between countries can affect manufacturing output and global supply chains. Silver, being an integral component in various industrial processes, is sensitive to these changes. Positive trade relations and stable economic policies foster a conducive environment for industrial growth, thereby increasing the demand for silver. Conversely, trade wars or protectionist measures can disrupt industrial production and reduce the demand for silver. In recent years, the trade dynamics between the United States and China, the world's 2 largest economies, have been a focal point for investors. Tariffs, trade agreements, and geopolitical tensions between these 2 nations have had significant ramifications on global markets, including the silver market. A stable trade environment supports industrial growth and, by extension, the demand for silver. Manufacturing activity is a key driver of industrial demand for silver. The metal is used extensively in the production of electronics, solar panels, and automotive components. Therefore, trends in global manufacturing activity have a direct impact on silver prices. Strong manufacturing output signals robust economic health and higher demand for industrial metals, including silver. Conversely, a slowdown in manufacturing can lead to decreased demand and lower prices. Recent global economic data indicates varying trends in manufacturing activity across different regions. For example, the rise of manufacturing activity in Asia, particularly in China, has been a major driver of silver demand. China's significant investments in renewable energy and technology sectors have bolstered the need for silver. On the other hand, economic slowdowns in other parts of the world can offset these gains, leading to a more complex and sometimes volatile market environment. Technological advancements are a critical factor influencing the demand for silver. Innovations in sectors such as renewable energy, electronics, and automotive industries continuously create new applications for silver. The push towards green energy, exemplified by the increased production of solar panels, significantly boosts silver demand. Solar panel manufacturers use silver for its high conductivity and durability, making it an essential component in photovoltaic cells. The electronics industry, driven by advancements in consumer electronics, 5G technology, and the Internet of Things, IoT, also contributes to the growing demand for silver. The metal's superior conductive properties make it invaluable in producing semiconductors, switches, and connectors. As these technologies become more widespread, the demand for silver is expected to rise. In the automotive sector, the shift towards electric vehicles, EVs, and hybrid cars has further enhanced silver's industrial demand. Silver is used in the electrical systems of these vehicles, and as the global automotive industry increasingly adopts EV technology, the demand for silver is projected to grow. Global economic health. The overall health of the global economy influences silver prices through its impact on industrial demand and investor sentiment. During periods of economic growth, industrial activity typically increases, leading to higher demand for silver. Conversely, during economic downturns, reduced industrial production can decrease silver demand. Additionally, economic crises often drive investors to seek safe haven assets like precious metals, including silver, which can boost its price. For instance, the global economic recovery post-COVID-19 has seen fluctuations in silver demand. While industrial activity rebounded in some regions, supply chain disruptions and varying recovery rates across countries created a complex market environment. Michael Pento's analysis suggests that monitoring these global economic trends is crucial for predicting silver price movements. Inflation and currency fluctuations also play a significant role in the silver market. High inflation rates can drive investors towards silver as a hedge against currency devaluation. Conversely, a strong dollar can make silver more expensive for holders of other currencies, potentially reducing its demand. Monitoring inflation trends and
nothing has healed as far as the banking system is concerned. We have had the longest inverted yield curve inversion, so the 10s minus 2s inversion in history. The longest inversion, which really brings down net interest margins for banks, because how do they make money? They have to pay their depositors, but they're collecting interest on loans. Well, if the interest they're collecting on loans is equal to or less than what they have to pay on deposits, it's a pretty hard way to make money. And if they don't want to raise their deposit rate, you have something called capital flight. People take their money out of the bank and they moved it to brokerage accounts. And you end up with a lot of money flooding into T-bills. So that's what's occurred. In fact, if you look at the reverse repo facility, something also I look assiduously at, is that has equated to the draining of that reverse repo facility, which is excess reserves from banks that was parked, laying fallow at the Fed. That has pushed, just in the last 12 months, $1.7 trillion of gambling money into Wall Street. So that money came out of the reverse repo facility, went in to buy bonds, newly issued bonds. That money is circling in the economy. And that's when you get, roaring kitty stocks going through the moon, and you have Nvidia going up, the market cap of Berkshire Hathaway in a few days. It's insane. But that's $1.7 trillion is now there's only about $350 billion left in that reverse repo facility. And I'm really watching the bond market, because when that liquidity runs dry, and it's not too long away now, it's very close. Talking about months, not quarters.
Market sentiment and speculation are critical elements that influence silver prices. These factors are often driven by investor perceptions and reactions to economic news, geopolitical events, and market trends. Michael Pento's analysis underscores the significant impact that market psychology and speculative activities can have on silver's price movements. Investor sentiment reflects the overall mood and outlook of market participants. When investors are optimistic about the economic outlook, they are more likely to invest in riskier assets, including commodities like silver. Conversely, during periods of uncertainty or pessimism, investors may flock to safe haven assets, such as precious metals, driving up silver prices. For instance, economic data releases, such as employment reports or GDP growth figures, can significantly influence investor sentiment. Positive data may boost confidence in economic growth, potentially increasing industrial demand for silver and pushing prices higher. On the other hand, negative data can trigger fears of economic slowdown, prompting investors to seek refuge in silver as a store of value. Speculation, which involves trading based on anticipated price movements rather than fundamental values, also plays a substantial role in the silver market. Speculators, including hedge funds and individual traders, often use leverage to amplify their positions, which can lead to significant price swings. The actions of these market participants are closely tied to technical analysis, news events, and market rumors. For example, when technical indicators suggest a potential breakout, speculators may increase their buying activity, driving prices up. Conversely, if indicators point to a downturn, selling pressure from speculators can lead to rapid declines in silver prices. Technical analysis is a tool frequently used by speculators to predict future price movements based on historical data and chart patterns. Key technical levels, such as support and resistance, are closely watched. A breakthrough above resistance can trigger buying sprees, while a drop below support can lead to selling. Currently, the silver market is watching for a potential breakout above last week's high at $31.49, which could pave the way for a rally towards the 11-year high of $32.52. Conversely, a fall below the support level at $30.59 might lead to a decline towards the 50-day moving average at $29.67. These technical levels serve as important signals for traders and can significantly influence market sentiment and speculative actions. Geopolitical events also heavily impact market sentiment and speculation in the silver market. Political instability, trade disputes, and global conflicts can create uncertainty, prompting investors to seek safe haven assets like silver. For instance, tensions between major economies or disruptions in key industrial regions can affect supply chains and production capabilities, influencing both physical demand and speculative trading. Additionally, the actions and statements of central banks, particularly the Federal Reserve, can have a profound impact on market sentiment. As previously discussed, expectations of interest rate changes and monetary policy adjustments influence investor behavior. Speculative trading often intensifies around major announcements or testimonies by central bank officials. Jerome Powell's congressional testimony is a prime example, where hints of a dovish stance can boost silver prices, while a hawkish tone might dampen market enthusiasm. Michael Pento's analysis highlights the intricate relationship between market sentiment, speculation, and silver prices. He points out that while fundamental factors like industrial demand and economic indicators are crucial, the psychological and speculative elements of the market can lead to significant price volatility. This dual influence means that silver prices can experience rapid changes based on investor mood swings and speculative trades, often leading to short-term price spikes or drops. In conclusion, market sentiment and speculation are pivotal in driving silver prices. Michael Pento's insights emphasize the importance of understanding these factors alongside fundamental economic indicators. By keeping a pulse on investor sentiment, technical signals, and speculative activities, market participants can better anticipate silver price movements and make informed investment decisions. The interplay of these psychological and speculative elements with broader economic trends creates a dynamic and often unpredictable silver market landscape.
I mean, it's a question that you can't answer unless you say these people are disingenuous, they're using mendacity, they're prevaricators, they're liars. They care about one thing and one thing only, is that their jobs and their position and to maintain power. And they'll do it at any cost. I mean, anybody, I'm not talking about someone who's uneducated and ignorant. A person who is the former head of the Federal Reserve, who is now the head of the Treasury, that tells you that the highest ratio of debt to GDP we've ever seen, and that's including World War II, the immediate aftermath of World War II, in good times, thinks that that's a good place and sustainable. I mean, you talk about incompetence. I mean, Joseph Goebbels is someone who comes to mind of, Baghdad Bob, who tells you, the news you think you want to hear instead of the truth. I hate to use those kind of, alliterations, but you're just not getting the truth from these people.
Silver and gold, Both precious metals share several characteristics, but also have distinct differences that affect their price dynamics. Michael Pento's analysis highlights the importance of understanding these differences and the relationship between the two metals, often measured by the gold/silver ratio, to forecast silver prices effectively. The gold/silver ratio is a widely used metric that indicates how many ounces of silver are needed to purchase 1 ounce of gold. Historically, this ratio has fluctuated significantly, influenced by various economic, industrial, and market factors. Currently, the gold/silver ratio stands at 76.58, meaning it takes about 76.58 ounces of silver to buy 1 ounce of gold. This ratio is a useful tool for investors to assess the relative value of silver compared to gold. Silver tends to be more volatile than gold. This higher volatility is partly due to its dual role as both a precious and an industrial metal. While gold is primarily viewed as a store of value and a hedge against economic uncertainty, silver's price is also heavily influenced by its industrial applications. This dual nature means that silver prices can be more sensitive to changes in economic conditions, manufacturing activity, and technological advancements. For instance, during periods of economic expansion, the demand for silver in industrial applications, such as electronics, solar panels, and automotive components, tends to increase, driving up its price. Conversely, during economic downturns, reduced industrial activity can lead to a decline in silver demand, making its price more susceptible to drops compared to gold. Gold, on the other hand, is often seen as a pure hedge against inflation and economic uncertainty. Investors flock to gold during times of financial instability, currency devaluation, and geopolitical tensions. While silver also benefits from these safe haven flows, its price movements are more influenced by industrial demand fluctuations. This makes silver a more speculative investment compared to gold, with higher potential for both gains and losses. The historical performance of the gold/silver ratio provides insights into market conditions. For example, during the economic turmoil of the late 1970s and early 1980s, the gold/silver ratio dropped significantly as silver prices surged due to both increased industrial demand and speculative buying. Conversely, during periods of economic stability, the ratio tends to rise, reflecting silver's lower industrial demand compared to its peak levels. Michael Pento's analysis suggests that understanding the gold/silver ratio can help investors make more informed decisions about the timing of their investments in these metals. A lower ratio often indicates that silver is outperforming gold, which can signal robust industrial demand or heightened speculative interest in silver. A higher ratio, on the other hand, may suggest that gold is outperforming silver, possibly due to stronger safe haven demand for gold during times of economic uncertainty. Currently, the relatively high gold/silver ratio suggests that gold is more favored as a safe haven asset, reflecting market concerns about economic stability and inflation. However, as industrial demand for silver continues to grow, particularly with advancements in renewable energy and technology, the ratio could decrease, indicating a stronger performance for silver relative to gold. Additionally, the gold/silver ratio can provide clues about market sentiment and future price movements. For example, if the ratio starts to decline, it could signal increasing confidence in the global economy and rising industrial demand for silver. Conversely, increasing ratio might reflect growing economic uncertainty, with investors seeking the relative safety of gold. In conclusion, a comparative analysis of silver and gold, particularly through the lens of the gold/silver ratio, is essential for understanding the dynamics of the silver market. Michael Pento's insights underscore the importance of considering both the industrial demand for silver and its role as a precious metal when making investment decisions. By monitoring the gold/silver ratio and the factors influencing it, investors can gain a better understanding of market trends and potential price movements for both metals. This comprehensive approach helps in navigating the complexities of the precious metals market and making informed investment choices.
Consumer. But I think for wealthy individuals, there's going to be a means test of Social Security. If you're worth the X and if you make this much, whatever the number they come up with, they'll say you don't need it and just take it away from you. That's why I told my wife, she says, why are you, and I'm 60 years old. I'm going to start taking it at 62. I'll take whatever they give me because I don't think in the next few years that they're going to allow everybody to take Social Security. They'll means test it. But even if you're just the average consumer, I would take it anyway. Again, this is not financial advice. This is just my opinion of what I would tell a friend if I knew them well. Take it because I think that they're not going to default explicitly on the Social Security commitment. They will default through inflation. They'll just print it all away. So you'll get your nominal stipend, but it won't buy you anything. That's how I think they're going to default. I mean, they're going to default either way. They have to default. Just tax base is not there. There's not enough workers for retirees. The ratio is upside down. It's nowhere near where it was in the 30s when they started this program. So they will default through inflation. So take what you can now and invest what you can now to protect yourself from a depreciating currency vis-a-vis hard assets, not against other flawed fiat currencies, but against hard assets.
Economic downturns have profound implications for the price dynamics of silver. Michael Pento's analysis highlights the critical role that recessions, liquidity crises, and broader economic instabilities play in shaping the market for silver. During economic downturns, several interconnected factors come into play that can influence the demand for and price of silver. During a recession, industrial activity typically slows down. Given silver's significant industrial applications, a downturn in manufacturing, technology production, and other industrial sectors can reduce the demand for silver. For instance, sectors such as electronics, renewable energy, and automotive, which are major consumers of silver, often see reduced activity during economic slowdowns. This diminished industrial demand can put downward pressure on silver prices. However, silver also benefits from its status as a safe haven asset. In times of economic distress, investors often seek out precious metals like silver and gold to protect their wealth from market volatility and economic instability. The dual nature of silver's demand, industrial and investment, means that while its industrial demand might decrease during a recession, its investment demand can increase significantly. This increased demand as a safe haven asset can help stabilize or even boost silver prices despite reduced industrial consumption. Liquidity crises are another important factor. During periods of financial stress, when liquidity dries up in the financial system, investors may sell off assets, including precious metals, to raise cash. This can lead to short-term price drops in silver. However, as central banks and governments intervene with monetary stimulus and liquidity injections, the conditions often become favorable for precious metals. Lower interest rates, increased money supply, and investor concerns about fiat currency stability can drive demand for silver and other safe haven assets, pushing prices higher. The response of central banks to economic downturns is crucial. During past recessions, central banks have often resorted to lowering interest rates and implementing quantitative easing to stimulate the economy. These measures can create a favorable environment for silver prices. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver, making them more attractive to investors. Additionally, quantitative easing and other forms of monetary stimulus can lead to concerns about inflation and currency devaluation, further driving demand for silver as a hedge against these risks. Michael Pento emphasizes that the potential for economic downturns is a significant factor in his bullish outlook for silver. He points out that current economic indicators suggest a slowing economy, with rising unemployment and disappointing retail sales. These signs of economic weakness increase the likelihood of a recession, which could trigger the kind of central bank responses that are typically supportive of higher silver prices. Furthermore, the structural issues in the global economy, such as high levels of debt and deficits, add to the potential for economic instability. Countries with high debt-to-GDP ratios and large fiscal deficits may find it challenging to navigate economic downturns without resorting to aggressive monetary and fiscal interventions. These interventions often lead to currency devaluation and inflationary pressures, conditions under which silver tends to perform well. Geopolitical risks also contribute to economic uncertainty. Trade tensions, political instability, and conflicts can exacerbate economic downturns and increase market volatility. In such an environment, the appeal of silver as a safe haven asset grows, as investors seek to protect their portfolios from geopolitical risks and the associated economic fallout. In conclusion, potential economic downturns have a complex and multifaceted impact on silver prices. Michael Pento's analysis highlights the dual influences of reduced industrial demand and increased investment demand during recessions and liquidity crises. The response of central banks and governments, through measures such as interest rate cuts and monetary stimulus, plays a crucial role in shaping the silver market during these times. Understanding these dynamics is essential for investors looking to navigate the silver market and capitalize on potential price movements during periods of economic instability.
It's not my prediction anymore, it's a fact. If you look at initial jobless claims, the highest 4-week moving average since September 2023, continuing claims up by 15,000. That moving average is also, 4-week moving average is also the highest in quite a while. If you look at Philly Fed that came out today, if you look at retail sales, great disappointments. If you look at pending home sales, they're all not anywhere near as projected. They're all falling well short of the mark. So I don't think we're in a recession yet, but we are tending towards that direction. And on the other side of the coin, you look at, the markets. If you look at NVIDIA, it's adding the market cap of McDonald's every day. When you have a very narrow rally like this, it tends to mask what's going on underneath. For example, would it surprise you if I told you the equal weight the equal weight S&P 500 is up 4%? That includes NVIDIA. It just doesn't overweight it because of its market cap. It equals it. If you look at the Russell 2000, that's down year to date. There's 2,000 stocks there. So lots of cross currents, but the economy is clearly weakening. It's being masked by what's going on with the AI phenomenon in NVIDIA. All such narrow rallies have failed miserably in the past. You look at the Nifty 50, or if you look at the .com phenomenon. But this is really a rally now that's just like one stock. So the market's very narrow. The economy's clearly weakening. If you look at things such as financial conditions and credit spreads, and that's what I would really look towards to let me and my investors know when we need to get short, net short in the portfolio, they're still quiescent, remarkably. But this data that's coming out just over the past month or so is really starting to lend credence to the fact that we are slowing towards a recession. I think it's inevitable that we have a recession by the end of this year.
In conclusion, Michael Pento's analysis provides a comprehensive view of the multiple factors that could potentially drive silver prices to $1,000 per ounce. By examining the current silver price trends, the influence of the Federal Reserve's monetary policy, key economic indicators, industrial demand, global economic factors, market sentiment, and speculation, the comparative analysis with gold, and the impact of potential economic downturns, a nuanced understanding of silver's future trajectory emerges. Silver prices are currently on an upward trend, driven by investor anticipation of dovish signals from the Federal Reserve. The potential for interest rate cuts, as indicated by recent data, strengthens silver's appeal as a non-yielding asset in a low-interest rate environment. As the Federal Reserve navigates a complex economic landscape marked by rising unemployment and inflation concerns, its monetary policy decisions will be crucial in shaping silver's price dynamics. Economic indicators, including labor market data and inflation metrics, provide valuable insights into the broader economic health and influence silver prices. Higher unemployment rates and cooling inflation could prompt further rate cuts, boosting silver's investment appeal. Conversely, persistent inflation might necessitate a more hawkish stance, impacting silver differently. Industrial demand for silver, driven by sectors such as renewable energy, electronics, and automotive industries, remains robust. The push towards green energy and technological advancements continues to increase the need for silver, underscoring its dual role as a precious and industrial metal. This industrial demand, coupled with its safe haven status during economic uncertainties, creates a unique demand dynamic that supports higher prices. Global economic factors, including trade relations, manufacturing activity, and geopolitical risks, add another layer of complexity to silver's price movements. Stable trade environments and strong manufacturing output drive industrial demand, while geopolitical tensions and economic instability increase silver's safe haven appeal. Market sentiment and speculation significantly influence silver prices. Investor perceptions, technical indicators, and speculative trading activities can lead to rapid price swings. Understanding these psychological and speculative elements is crucial for predicting short-term price movements. Comparing silver with gold through the gold/silver ratio provides additional insights into their relative performance. Currently, a high gold/silver ratio suggests a stronger preference for gold as a safe haven asset. But as industrial demand for silver grows, this ratio could shift, indicating stronger silver performance. Potential economic downturns, characterized by recessions and liquidity crises, impact silver's industrial and investment demand. During economic slowdowns, industrial demand may decrease, but silver's appeal as a safe haven asset often leads to increased investment demand. Central bank responses, including rate cuts and monetary stimulus, typically support higher silver prices in such environments. Combining these factors, Michael Pento's outlook for silver is cautiously optimistic. The interplay of Federal Reserve policies, economic indicators, industrial demand, global economic conditions, market sentiment, and potential economic downturns all contribute to the complex dynamics driving silver prices. As these elements converge, the potential for silver to reach $1,000 per ounce becomes more plausible, especially if economic conditions and central bank policies align favorably for precious metals. Investors should remain vigilant, monitoring these factors closely and adapting their strategies to navigate the evolving market landscape. By understanding the multifaceted drivers of silver prices, investors can position themselves to capitalize on potential price movements and maximize returns in the silver market.
You could all be replaced by artificial intelligence. We'll have digital human beings doing your job, and you'll just sit home and wait for your government check to arrive in digital currency. They'll just deposit it in your bank account, and everything will be fine. You'll just sit back and watch TMZ and reruns of Jerry Springer. And your intelligence will go down, your autonomy will go down, your privacy will be removed, and you'll be fine. What's to worry about? Doesn't that sound wonderful? Look, AI is a very disruptive technology. I'm sure it'll boost productivity in the long run, but it could be very disruptive to the labor force. They tried it, post-COVID, helicopter money. I think they'll do it. I think they'll be forced to do it again. And I think they'll also have to take complete control of your currency, because interest rates are going to have to be negative in real terms for a very, very long time, maybe even in nominal terms for a very long time. And that requires paper currency, physical currency to disappear for them to accomplish that task. See, what's to worry about?